I've spent a couple of months backtesting and deploying automated trading strategies, and it started to seem to actually have an edge, which meant that I could finally ask the fun question, what would it take for this thing to make $1 million a year? I've got about 5 months of live data, so the math is easy. Risking $30 per trade would pay about 10K per year. 100 per trade would pay 32K per year. Keep writing that line up, and $1 million a year means risking about $3,300 per trade. I'm using Hyperliquid Exchange, so the obvious next question is, can Hyperliquid even absorb orders that big? Here's silver, my bot's best performing asset. I picked one data point from a real trade, and the amount sitting at the best price on the order book was only $650. My bot's order for that trade was already 13 times that size. That's just the first level of the order book. So the question is, how much slippage should I expect for a trade 13 times the size of the first level in the book? I've learned nuance when dealing with bots since this first measurement. And there's a lot to think about when making a trading bot beyond just a good looking backtest. This video is honestly months of learning about things to consider when deploying and scaling a strategy. First, I'll briefly just mention that the bot trades liquidity sweeps in ICT-style setups on Hyperliquid's commodity and index markets. So like silver, oil, S&P 500, and NASDAQ. It gets maybe 1 or 2 trades a day, sometimes 7, sometimes 0. Right now it risks $25 per trade. You generally want to think about a trading strategy in terms of a consistent risk being taken on each trade. With conventional futures contracts, it's a little harder to be precise. But with perpetuals on Hyperliquid, I can basically decide exactly what I want my risk to be in a trade. And given the distance between the entry and the stop loss level, calculate the exact size that's needed to hit the target risk. This bot can take some pretty small moves. The thing about tight stops is that you need a really big notional position to make money off of them. Back in July, $15 of risk worked out to $22,000 notional position. As I moved up risk, the exchange pretty quickly started rejecting orders due to insufficient margin. So I used the backtest to derive a formula for how much funding the account needs to get a 95% of trades at the desired target risk. It came out to about 100 R, where R is the risk. This would quickly reach a lot of capital to deploy when scaling. So I spent some time getting that requirement down through some optimizations. And finally, I got a clean chart to show profit versus funding. On paper, it's a straight line. But of course, at this point, the book depth was not being considered. So where the limits on possible profits was the next big question. That initial $650 reading was from just one trade. So I needed a lot more order book data and more trades to get a more accurate reading. A few weeks after collecting, with real trades accumulated against order book snapshots, I was able to get a better measurement. The data says with silver, I can reach about $32 of risk and oil about $124 before slippage would hit 5%. $32 of risk could be like $50,000 notional in a trade. So this is obviously much better than the initial estimate that the order book is just $650 thin. But still, as I said before, $30 of risk is not going to make a lot of money per year. The indices order books look much deeper than oil and silver, but the strategy that I have performs about half as well on these. So I'll probably spend some time seeing if I can get these to perform better with minimal changes to the overall strategy. I think that that would be a low-hanging fruit for me. But here was an interesting discovery. Due to the nature of the entry model, the price tends to move down into a limit order. And the median from live data is 1 basis point better than the asked for entry on average, where 1 basis point is about 5% of the trade's risk. So over the month of June, that was an 11R bonus to the strategy. However, in the exits, we get the opposite, the negative kind of slippage, where the median was 1.15 basis points. So overall, the slippage is actually close to negating itself. But I'm actually not so convinced that this scales with R. There was one time at the end of July that I tried raising the risk on oil. And sure, technically it was an unlucky trade, but I ended up losing almost 3R in one trade due to slippage. Luckily, I was already recording the order book data, so when this trade happened, I can see that the position was only 0.5% of the entire flush volume. So my trade was not the catalyst for the flush, but it reminded me that the bigger the position is, the harder it is to fill completely. I also noticed that some trades are missing entirely or only partially filled live. You can do everything in your power to make sure live and backtest match each other perfectly in terms of the logic and the code. But the fill model is almost entirely impossible to simulate accurately. The best I could do was to use my live fill data so far and build a new fill model which applies an average penalty from slippage and missed trades on the backtest. The strategy lost about 10R over 5 months from this new fill model. But moving forwards, the backtest has been consistently closer to modeling the actual live profits. So overall, this was a good thing. One other idea I've been playing with is maybe R doesn't need to be fixed to match the backtesting. Before each entry, my guess is the order book can be used at that moment to estimate how big of a trade can be made without too much slippage. Up until now, I've kept R always the same, so that as long as backtests show the win rate is above 33% and the average risk to reward ratio is at or above 2 to 1, then I know it's a profitable strategy just by those numbers. If the bet size were to change per trade, that's a new variable that might affect the ratio of the risk to reward. If losing trades tend to be larger than wins, the win rate doesn't matter if it's being outsized. Unfortunately, I don't have a ton of order book data to backtest this and see if my strategy would, over the last few months, still be profitable if I always took the largest trade possible, that is. I only have a few weeks of order book data. So I took these 2 dozen or so trades that I do have, and I measured the distribution of sizing in both wins and losses. And it looks pretty random and evenly distributed across size between wins and losses. So it may be possible to estimate an average R based on a size range that I'm willing to trade. And this average R may be larger than what's possible if R were always consistent. So it actually kind of makes sense that sizing wouldn't be correlated with wins or losses because if it were, I could use that information to decide whether to take a trade in the first place, which would be like a useful signal. So the question I started with, the $1 million a year, right now the answer is no, not with this fixed risk model at least. Silver tops out around $25 a trade, and that's where we're already running. But it's not out of moves yet. The fluid R idea is the one I'm most curious about right now. Um, so as the collector keeps running and picking up more trades, I'd also like to spend more time on the indices and see uh, if those can be improved, since that's where all the depth is sitting. So in general, if you're running any kind of strategy with real money, remember that your own fills are the best data set you will ever get, and use it to improve your backtesting and discover your blind spots. That's all for now.